Those bullish on gold have long been seen as fringe players in the financial world. Serious investors have dismissed gold as an asset, as most part of it sits in jewelry, yielding nothing. Hi, welcome to economictimes.com. I am Sakshi Parashar. This year, gold is the best performing traditional asset in the world. The yellow metals turned new highs by breaking all records of its past amid coronavirus. Even when the world is struggling for better economy and dealing with rising cases of COVID-19, gold has proved itself to be a safe haven. While it is said that gold gains more traction when interest rates are low and political and economic uncertainties are high, it is equally important to understand when you should park your money in gold.
Time and again, when we have seen losses in equity markets, gold has done well. Like in the COVID crisis, when everything fell, like your equities took a significant loss, was one asset that was helping your portfolio. We also saw in 2008 crisis, when markets fell by more than 50%, gold was up more than 30%. So time and again, whenever there is a crisis, gold helps your portfolio.
Indians have a special connection with the precious metal. In India, every time is a good time to invest in gold. Here's what experts have to say about the outlook and the time to invest in gold.
What we are seeing in the macroeconomic factors is the crisis that we had, the COVID crisis, is snowballed into an economic one. And therefore, central banks have acted the way they do every time, with printing a lot of money by what we call as quantitative easing measures. They are buying all assets. Second is they have cut interest rates drastically. And these interest rates, we think that will stay low for a fairly long time. If you see the 2008 crisis, even after the crisis was over, they kept rates low for 6 years. This crisis is much larger in magnitude. Therefore, we think the accommodative stance from these central banks will be for much longer time, which means that real rates is interest rates minus the inflation, will stay low to negative for a fairly long time. And that's a bullish factor for gold.
If we see the central banks, interest rates are close to zero, the bond yields are close to zero. If we see the inflation is on the rise because of the money being pumped in, because of the stimulus measures, we are seeing the dollar getting weaker and weaker day by day. So in the near term, I think these factors are going to support gold prices. We have also seen a significant purchase of gold from most of the central banks across the globe. Even the ETFs, retail and HNI institutional investors purchasing gold through electronic traded platform is also at a record high level now. This signifies that the steam is still left in gold's rally, and by Deepavali we may see gold prices touch close to 60,000 rupees per 10 grams in domestic market, and at COMEX we may possibly see a level of close to $2,250 to $2,300 per troy ounce.
While many of us consider it as safe to invest our money in gold, we usually lack the understanding of right instrument to invest in. Gold can be bought in physical form like jewelry or through financial instruments or paper gold, that is gold exchange traded funds, sovereign gold bonds, etc. Now let's understand from our experts which is the best instrument to purchase gold.
I think the gold ETFs or the gold mutual funds, called as the gold saving funds, are the best way for one to take exposure to gold because they are very, very price efficient. If you see, you can buy at retail level smaller denominations of gold at very, very wholesale prices. That's the efficiency that the gold ETFs translates from the wholesale level to the retail level. And that is why they make up for a very good investment. Secondly, you don't have to worry about purity. Time and again, we have seen there are concerns when you buy gold. If you see recently, there were 83 tons of gold being unearthed at fake gold in China. So there is always a question on the purity of the gold that you buy. Then third is liquidity. You can invest, or you can invest or redeem your investment at any point of time at the prevailing gold price when you buy through gold ETFs or gold saving funds. Whereas in physical gold, you have to take discounts. There are buyback discounts and those kind of things that impact your redemption price. So gold ETFs, from all accounts, in terms of price efficiency, in terms of safety of the gold, purity of the gold, liquidity. On all factors, they are very, very good instruments. And there are sovereign gold bonds. I think sovereign gold bonds, firstly, investors don't like it because they are not backed by gold. Gold at the end of the day is an asset. When you buy a bond which is not backed by gold, you're changing the form of the asset to a liability. And therefore, many investors don't like that. There is a advantage in terms of the interest that you get, but at the same time, they are very, very illiquid. You may have to take a discounted price, and that's a significant discount that we are talking about when you want to redeem the sovereign gold bonds.
Apart from these instruments, there's one more way to invest in the yellow metals, and that is through commodity stock exchange such as MCX.
Now, gold futures are simple financial instruments that are traded on electronic exchanges like MCX, NSE, and BSE. They have predefined quality, quantity, and time frame to suit various participants' requirements. In order to get started, all you need to do is find a service provider who is a member of these exchanges, open a trading account with them. Once the account is activated, invest 10 to 12% of the gold value you want to purchase. Invest by selecting the proper time horizon contract that suits your requirement. The prices are expected to stay firm. The prices have actually improved from $1,500 per troy ounce from March 2020 to the peak level that we saw of $2,080 per troy ounce at COMEX. And in domestic market, we saw the prices touch from 40,000 rupees per 10 grams to close to 56,200 rupees per 10 grams by August 2020. The liquidity on purchase of gold is fantastic. We see close to 25 to 30,000 crore kind of volume happening in domestic market in gold contract alone recently with the kind of volatility we have seen. But on an average also we see a volume of close to 15 to 20,000 crore happening in gold.
Now that we understand certain know-hows of investing in gold, it becomes important for us to know how much gold one should buy and what percentage of it should be in the portfolio.
So from an asset allocation point of view, I've always maintained that in every asset allocation portfolio, 10% should be gold because it provides you a hedge. So when nothing works, that time gold works. Tactically, now you can increase your asset allocation from 10 to 20%, but 10% should be there always.
When there is high uncertainty and you want to increase kind of a slightly higher allocation to gold, you may, but don't go overboard. It could be cheap. It should be not exceeding 20%. But that, if you want to redeem, I think in 2 to 3 years or 3 to 5 years time frame would be a good time for you to have that tactical allocation. But otherwise, we'll recommend that you have a 10 to 15% allocation at all times.
Are you wondering if investing in physical gold is a great option? Well, experts believe that it is one of the most inefficient forms of investment.
Whenever you're looking at investment in gold, jewelry is the most inefficient form of buying gold. You need to bifurcate what is for consumption and what is for investment. For consumption, you don't have an alternative to jewelry. But when it comes to investment, you are doing a disservice to yourself if you are going and buying jewelry for investment. It is very, very inefficient because there are markups at all levels. There are making charges. When you sell, you don't get that making charges that you have paid. Plus, you have to take discount on the gold, prevailing price of gold when you go to sell. So it is very, very inefficient form of buying gold.
First, you have to go and buy and sell. So you have to go into a market buy. Storage is a problem. Where to store?
Right.
Also, purity also becomes very important because there's spurious gold also which is available. On the other hand, if you want to buy a gold ETF, which is still pure reflection of buying physical gold, you can buy it on fingertips. You can just go on an app, buy it in 1 minute, and you can buy gold. Secondly, I think it's easy to store. It's just in a demat statement like other shares which are there, like mutual funds which are there. And secondly, I think the purity is backed by purest gold.
Yeah.
So in that sense, little gold is far more convenient. And also you can buy it in small quantities. On the other hand, it becomes a little tricky when you do it physical gold.
Hope you liked this video. For more such videos, log on to economictimes.com.